The Federal Reserve, as expected, raised rates by 75 basis points today. Markets reacted negatively on the news. Gold went down. The stock markets went down at 2 p.m. The U.S. dollar, initially down, rose dramatically following Jerome Powell's press conference after 2 p.m. What exactly is going on, and where are policy rates headed next? Gary Wagner, editor of thegoldforecast.com, is here to break all these things down with us today. Gary, welcome back to the show. Always a pleasure to have you.
Thank you so much for having me, and it's always a pleasure to be here.
Timely appearance, Fed Day, important. I'm just going to read a paragraph here from an article published by my colleague Anna Golubova at Kitco News. She wrote that gold lost all post-Fed statement gains as Chair Jerome Powell signaled that the ultimate level of interest rates would likely be higher than previously thought. He also said that the window for a soft landing has narrowed. Very hawkish words here. It's understandable that the markets will react negatively to a higher than expected ultimate level of interest rates. Although, of course, as you and I discussed offline, he didn't really comment on how high exactly the interest rates would go. He just said that the rate would need to be sufficiently restrictive to bring inflation back down to 2%. So let's comment on what happened with the markets today, and then we can talk about his rates and his policies of containing inflation going forward. What happened today, Gary?
Well, Powell went ahead and enacted, as he said he would, a 75 basis point rate hike. I believe this is the fourth consecutive rate hike of that magnitude.
Yes.
They began in March with 25. They followed that with 50. And then all of the rest of the FOMC meetings this year had a 75 basis point rate hike. They're up now around between 3 and 3.5. And the key is this: historically speaking, they want to get inflation to a target level of 2%. That has never been accomplished without raising their benchmark rate to at least equal the level of inflation. So if inflation right now, the PCE has actually been running hotter since they started raising interest rates, but for them to effectively curtail and start to reduce inflation in a meaningful way, they're going to have the Fed funds rate anywhere between 4.5% to 6% before it really grips into the fabric of the economy that's telling people money's too expensive to borrow. We're going to have to start cutting things back. And that's the primary problem that we're facing. As we've talked about before, I believe it's because the Fed didn't act in 2021 when interest rates began at 1.4%, and by the middle of 2021 was already at 3 or 4%. Back then, 0.25% or 0.5% rate hike would have had a dramatic impact. They believed it was transitory. Because they got that wrong, it really tore up any of their long-term plans.
Mm-hmm. All right, I want to touch on, before I come back to musing about what the Fed's going to do next, I want to talk about gold's performance. Now, as I said, not a huge move, but still bearish, a reaction. Now, it's surprising how, one could argue it's not surprising that gold would react negatively to higher interest rates, or the prospect of higher interest rates. That makes sense conceptually. But if you look at history, Gary, and this is what you and I discussed offline, gold didn't always react negatively to rising Fed funds rate. If you take a look at the last rate hike cycle, which happened between late 2015 and July 2019, the Fed funds rate rose from 0% to 2.25%. And gold steadily rose as well in tandem during that time period. You'll recall that gold was, on its way up to its highs in 2020. So why the negative reaction now, and what's different now than 5 years ago when we had the previous rate hike cycle?
A completely different economic environment. If we look at what the Fed is facing now, they've let interest rates, by assuming that it was transitory and it would work itself out, to incredibly unrealistic numbers. We were as high as 9.5% in the CPI. The PCE core index actually rose in September when you compared it against not only August, but year over year, and it's well over 6%. The key is that to effectively reduce inflation, you have to have enough pain presented, meaning you have to have interest rates matching or close to that level. Now, when we compare this to the earlier days, we were looking at inflation, as you said, at 2.5%, 3%. Yeah. So what do you have to do to curtail it? Well, maybe raise your interest rates, your benchmark rates to 1.5% or 2%. If we were dealing with 1.5% to 2% now, I guarantee that market participants would be focusing upon inflation sitting at 6% and not the tremendously huge raises and the magnitude of each hike in terms of interest rates. So they're apples and oranges in that prior they were working with a much smaller level of inflation and it was manageable to a large extent, whereas this scenario here is only manageable with some brutal actions by the Federal Reserve.
Okay, so you're saying that gold is going down because the pace of rate hikes this time is, I wouldn't say incomparable because we had the 1980s, but it's sufficiently high to bring gold down as compared to the past cycle. Is that basically the summary here? If you take I'll let you comment.
That is part of it, but the biggest part is something we haven't explored yet, and that is the absolute freight train we're calling dollar value. Of course, it's a misnomer because the dollar is fairly a weak currency, but when weighted against the basket of currencies that make up the dollar index, as I've said before, it's like looking in a basket of rotten apples and you pick out the least rotten apple, and that's the dollar. What's happening now is that yields are going up tremendously on 10-year notes, 30-year bonds. We've had yield inversions. And so when you have that occur where the yields are raising, the yields are quickly moving to higher ground, what happens is you bring in genuine interest into the fixed income asset class. And then what happens is that pulls the dollar higher because you have a lot of foreign investments coming in, buying our bonds, buying our notes, and they're buying them up ferociously because even where, for example, Europe has got inflation at 10.7%, that was just announced, their yields are nowhere near what we're offering. So if you're an international investor looking to park money and you want it to be a safe haven play and you want to use a fixed income, you're going to go to our debt instruments and not at debt instruments of other countries. And it is that fact that's been giving us dollar strength. And of course, there's a negative correlation between the dollar and gold because gold is paired here with the dollar.
Gary, I want to just examine history first before we talk about the future. It's important for the audience to understand what moves gold before we talk about your forecast here. Going back to the last rate tightening cycle between late 2015 and 2019, gold moved significantly. I mean, if you just take a look at a long-term chart, it looks like it's flat, but it was anything but flat. In late 2015, right at the precipice of the first rate hike in December 2015, gold was trading at around $1,100, give or take. Now, by the time COVID hit, by March 2020, gold was already above $1,500. That's a 50% increase over the course of 3.5 years. 3 years, just about.
Correct.
4 years. 4 years. Okay? So 4 years, 50% increase over 4 years. But during that time period, if you take a look at inflation in the U.S., it was relatively low, anywhere between 0 to 2%. We didn't have high inflation. Rates were going up, not down. So what was the main cause of this 50% increase over that 4-year period for gold?
You really have to put the move that you're talking about in context to a bigger picture.
Okay.
Middle of 2011, gold hits the first of many record highs at $1,920. It then kind of oscillated between 1900 and 1800 for a while. Then it broke down to oscillating between 1800 and I think 1564. I remember that number well because it stood there for 2 or 3 years. And then it methodically just started selling off until it hit just above $1,000. Now it's end of 2015, beginning of 2016. So now you've got inflation that is still mild compared to what we're looking at now. And you've got gold moving up. The focus was on the fact that it was easier to move gold up because inflation wasn't considered a tremendous problem that would wreak havoc on the economy. We're concerned now that the level of inflation the Fed is going to have to raise rates to will not only create a hard landing, but actually a recession. Now that's contrary to the last report we got last week of third quarter GDP, which actually showed robust growth, which I find is kind of interesting. I'd like to look at those numbers deeper. But the point was there wasn't that genuine concern that inflation was going to run rampant and out of control back then. And so they could focus on gold. And plus, you didn't have the same dollar strength that you do now.
Okay. It's just, I bring this up because when I talk to people about gold, a lot of the common assumptions for a higher gold price tend to be higher inflation, or higher inflation expectations at least. Decreasing real interest rates, of course, there's a very strong correlation there. Geopolitical risks, equity volatility, all these are common variables that you hear that will drive the gold price up. We had literally none of those things in the 2015 to 2019 period. There wasn't a big war going on in Europe. Inflation, like we mentioned, was low. Stock markets were booming. The real interest rate I'm looking at is positive. It's just a curious time for gold to move up 50%. So I'm just trying to understand here.
Well, you have to look at the fact that back then, 2 or 3% levels of inflation was considered dramatic. We were coming out of a stages of stagnation where there was very little inflation. So the fact, it's all relative to what we witnessed before. So all of a sudden you have 2 or 3% inflation. Market participants are going to focus upon inflation. It's not so bad that they're concerned that the Federal Reserve is going to turn things topsy-turvy. So they'll focus on inflation growing means that gold should move higher. In this case, we've got a scenario where interest rates are detrimental to any real growth, one, and two, it's impossible to focus on gold's value increasing when you're armed against extreme dollar strength. The dollar has been sitting at a 20-year high. It went to 114 on the dollar index. It's back down, I believe, around 109. Actually, today at 112, so not that far off. But it's this extreme dollar strength that is really forcing people to not look at gold as a safe haven asset that will appreciate, but rather that it's becoming less and less valuable as our dollar gets stronger and stronger.
Okay. All right. Well, let's talk about the Federal Reserve and what they're probably going to do next, and then we'll tie it all back into your gold price forecast. So the Fed, like I said, relatively hawkish tone that Jerome Powell had. He also said, though, we have still some ways to go before we reach, I'm paraphrasing here, before we reach that critically restrictive level that's necessary to bring down inflation to 2%. The question is, and that's one of the questions they're exploring, is how high does the Fed funds rate need to go? And now you posed a very good philosophical question to me offline earlier, and this is your question, not mine. It's a very good one. You said, what happens when the rates go to, let's say, 6% and inflation is still persistent? I mean, Powell doesn't know, or maybe he does, he's just not telling us exactly how high the rates will go. He's just saying it needs to be, restrictive.
Right.
That's not a quantitative number. He didn't say exactly when he'll stop raising rates. He'll just say he'll look at the economic data. So suppose rates go to 6%, inflation is still high. What's next?
Well, since I asked the question, what's your answer?
We're gonna flip the tables here. I think by that point, let's do some musing here. I think by that point, we're going to be in a serious recession if rates go to 6%. Rates are already, nowhere near 3%, and equity markets are already reacting the way they are. Mortgage rates are becoming unaffordable for a lot of people. At 6%, we're going to get a major calamity, I believe, and the Fed will have no choice but to pivot, because their other mandate is to control unemployment. They can't let unemployment go, through the roof at the expense of inflation. Right. So that's what I think. I don't think they'll let rates go to 6%. Is my thought.
I couldn't have said it better myself. That was a spot on answer. The key, as far as I am concerned, is that when you consider that they're looking to move interest rates to, say, 5% minimum, they want to get inflation target to 2. So they're going to have to go to 5, maybe 5.5. That will devastate, if it already hasn't begun to totally erode, the new housing market, rental incomes, the ability for first-time buyers to be positioned into a house, because as you know, the way a mortgage works is they take all of your income, they take the current interest rate, divide it into a payment, and say you can spend up to 25% of your net income for your mortgage payment. Now, when that mortgage payment doubles because interest has gone from 2% to 6% or 5%, it really prices the majority of people out of homes, and those that aren't priced out are priced out of the homes they wanted. So you get a huge contraction in the housing market. And that contraction, because it's such a big component of our overall industry and growth in North America and Canada, as well as the United States, that it is going to truly be detrimental on having economic prosperity. You can't have it when people can't buy a new home or even rent a home. You can't have the kind of prosperity that we have grown so accustomed to.
Mm-hmm. It's very interesting. Sorry, go on.
No, go on.
I was just going to say it's very interesting because even at 6%, it's not a very high rate by historical standards. Even in the late 1990s, early 2000, the interest rate was at exactly 6.5%. I'm looking at the Fed funds rate. Yes, we saw a tech bubble burst in 2001, but that wasn't entirely the Fed's fault. In fact, rates came down after the tech bubble burst. I'm just saying, things weren't unaffordable back then. Why are people so concerned about us? Let's just throw 6% out there. Why are people so concerned about a 5-6% Fed funds rate now?
Well, let me give you an example, okay? Yeah. On a $500,000 mortgage. Yeah. If you are getting a traditional 30-year fixed mortgage over time at 2.6%, and I know that one for sure because that's my mortgage rate, each $500,000 costs about $1,800 to service. A month. A month. Now, when you raise interest rates, it grows those payments exponentially because mortgages are front-end loaded. In other words, when you get a mortgage, year number one, if you pay them $1,000, $200 goes to the principal, $800 goes to the interest. Now, they go, oh, it's a great deal because you get to write off the interest, but you're not building equity in your property. It's not until many years down the road when you send them $1,000 and even half of it goes to principal and half of it goes to interest. So what's happening is because the way mortgages are set up, where they're front end loaded, you're paying that interest first. It's very hard to really tackle that mortgage quickly because all you're doing is paying interest off for the first 7 years.
I guess society has just been accustomed to near zero rates for such a long time that we've almost budgeted in a certain amount for housing, and now it's rising dramatically at a very fast pace. I think the pace here is important so that other things seem unaffordable, even though I think objectively speaking, mortgage rates 20 years ago were still higher, right?
Well, I doubt many will remember this, but back when inflation was absolutely out of control at the end of the 70s and 80s, you were looking at a mortgage rate at 16%.
Yeah, there you go.
So, but not many people could buy houses. That was the key. It was crazy and it was high, but you didn't have a huge percentage of the population actually being homeowners. Pretty much everybody except the extremely wealthy were priced out of it, and they bought cash anyway, so they didn't use mortgages. The key right now is that because the Fed stood back, believed inflation was persistent, especially in the 2021 when it started at 1.4 and ended at 7 or 8, they had plenty of time to have small incremental rate hikes. But because they incorrectly assumed that it would work itself out, it was a supply chain bottleneck that they had no control over, they got that so wrong that it is part and parcel for the vast majority of the financial problems we face today. And then there's another thing that we haven't even talked about, and I was reading about this months ago, but it's reappearing again, and that is the Federal Reserve's balance sheet, I think, is 8.7 trillion. Remember when they said they were going to taper? Mm-hmm. Well, it was at about 8.8 trillion. Now it's at 8.7, a year and a half later. In other words, they still got the majority of it. And guess what? With interest rates going up, when they service the debt on their balance sheet, they're losing billions and billions of dollars each and every month. Now, the Fed can handle that because they don't print money, but in a roundabout way, they increase the money supply. So it's not the same as if that was our problem, your problem, my problem. We would really have to batten down the latches, so to speak, so that we could get through a day and a day and a day. But it's gotten unrealistic in terms of how much money they're paying to service the interest rates, one. Two, then you go to Yellen in the Treasury. She's got to do the same thing. She's got to make interest payments on our national debt, which I believe is 31 trillion. So having rates at even 5 to 6% for any protracted period of time could wreak havoc on our long-term economic stability. Simply put, there might come a day when we really have to scrounge just to make those payments. And all we've ever done is kick the can down the road. We've never tackled that problem.
I haven't looked into this myself, but how much of our national debt, the $31 trillion you mentioned, are locked in at a fixed rate, so to speak? In other words, how much of it isn't going to be impacted by higher rates? Do you have an idea?
Well, I don't have the numbers, but I will tell you this. Yeah. As far as the Fed goes, they have mortgage-backed securities, mm-hmm. and they have U.S. debt instruments, notes, and bonds. Mm-hmm. They have to go and refinance them when they come, when they mature, and they have to refinance them at a higher rate.
Yes.
So it's a big impact. It's a tremendous impact. The article I read said that they were losing billions upon billions each month, and that was the Federal Reserve. Of course, Yellen has been very, very vocal about, look, we got to get something together because I'm not going to be able to pay these bills. Mm-hmm. And she's very prudently fiscal about doing these things. So she realizes that there's problems down the road there, too.
Well, let me just reframe the question that you posed earlier in a different way. Do you think that Jerome Powell will eventually be successful in bringing inflation back down to 2%? He seems pretty commitment. Let's suppose it doesn't happen. At what point does he abandon that commitment, Gary?
Well, the moment he would abandon it is when he gets offed and fired. That's his primary task, and he realizes that without getting inflation to some acceptable target, the target is 2, but even if they get it to 4, 3.5, somewhere where it's not in the 6s, it's going to dramatically improve the economic scenario. Think about the statement he made at the Jackson Hole Symposium. That was so focused, laser focused, saying we are solely committed to bringing inflation down no matter what it takes. We will, we'll do whatever it takes. All the adages in the world, that no stone will go unturned, whatever there was that would signify he's not quitting until it's done is the only attitude he can have, because without that, he's destined for failure. And even with that, he could fail.
Why are the odds so stacked against the Fed this time around?
Because they didn't act in 2021 when interest rates were at 2%. They waited until they went to 9.5%, 8%, before they even raised rates by a quarter basis point. It's ridiculous. Had they acted a year earlier, listen, things were returning to normal in 2020. There were still supply chain bottlenecks. Many people were working from home. The employment numbers were still great, but things were slowly pivoting to a new normal, whatever that new normal is, and I still don't have an answer for that. But they did nothing, and they did nothing because A, they assumed it would naturally work itself out, and B, they believed that there was nothing they could do to really dramatically affect it. And I think that both of those assumptions were very wrong.
Okay. All right, great points. Let's finish it off on gold. You've got some charts for us that you prepared. So on a technical level now, Gary, what are the levels you're looking for?
Well, I mean, on the main level that we have, and one thing that I've been doing is looking at a gold and dollar chart overlaid, because they've really moved vastly apart. 1621 is that double low that we hit at the end of September and then just a few weeks ago. It used to be 1680, it was 1700. Here's what scares me the most about gold. If you look historically speaking, since March, we have had consecutive lower highs and consecutive lower lows. We have not, except for this last occasion where we had equal lows. At $1,621, that doesn't warrant a whole lot of optimism, mind you. But as long as we're getting lower lows and lower highs, we've got to see that pivot, that turnaround. It will start with a V formation, but it has to end up with a high that's slightly higher than the previous high, or a low that's slightly higher than the previous low. Until that happens, we're going to see gold trade under more pressure. The other thing that you have to realize is that gold is reacting more than it, not than it ever has, but immensely to dollar strength. Mm-hmm. The dollar is at a 20-year high. So when you consider gold and the dollar this year, the dollar has decreased by 19%, okay? And gold from March to those lows decreased by 22%. So what are the real numbers? Gold has actually only declined 3% from March to now, but when you factor in dollar strength, you've got to add another 19%, and that's where we're getting this tremendously large number where gold's falling out of bed. In essence, gold isn't falling out of bed. The dollar is roaring. It's becoming king of the currency jungle. And because of that, you can look at gold and say, yeah, it's declined 19%. And it has, or 22, excuse me. But only 3 of those percentage points are based on sellers in the market. And that is an extremely unusual scenario. And I've been doing this for over almost 40 years now. I very rarely have seen this type of a scenario where the dollar is just so darn strong that it's eroding the cost of goods and services that are made in the United States and paired against the dollar.
You would think that the other way would be true, too, that imports would be relatively cheaper and that imports-related goods would be more affordable. I don't know if that's happening. Inflation still seems to be high.
Well, look, Eurozone inflation was just reported at 10.7. The problem with that thesis is that currencies are racing to zero. In other words, they're all every country is printing money. And so when you have every country printing money, that fiat currency is lessening in value all the time. And so when you have that type of a scenario, it's going to have the kind of damage we're witnessing. Mm-hmm. In other words, you would think that because the dollar is so strong, we'd have tremendous buying power in the Eurozone. And we do have better buying power there. We can buy more goods and services with the same dollar or $10 or $20, but it's not that much greater because inflation is eating them at a greater pace than it's eating us.
Interesting.
In other words, it's not really great anywhere.
No, especially if you're not traveling because there's a recession, then it doesn't really matter for you anyway. So Gary, give us your end of year gold price forecast.
That is a very, very difficult one. I mean, the end of the year is almost up. I don't think they will have resolved inflation in any meaningful way. I would hope that 1621 holds. I would like to see it move more like to 1680. But if 1620 does not hold, we could see easily the 1600 and 1580. That's on the downside. On the upside, if something happens where they actually get a handle on inflation, where the dollar begins to get weak because we have seen recent weakness, then I would have to look for gold to hit somewhere around $1,700 per ounce.
Okay, 17. That's slightly higher than what we are now. So you're moderately bullish, flat, neutral.
I'm a realist. I'm a realist at this point.
Well, you've got 8 more weeks, so it's not a huge time frame. Yeah. What about just to close it off? What about next year? What about the end of 2023?
I believe at some point in time, and I have no timeline for this, and I have no idea of how much pain will be between now and then to get there. But at some point, we will have regulated inflation to a new target. I don't think you'll ever see 2% for a while, but maybe 3.5%, which is going to be real acceptable when you're coming from 9, okay? And at the point that that happens, market participants will finally be able to shift their focus from higher interest rates to the value of gold as it's compared to other currencies that are fiat currencies. And that's when we could see gold take off. And at that point, I would not be surprised over the next 2 years to see it challenge 2,000 to 2,200. That's a longer term window that I'm looking at. But there's so many ifs involved in what needs to take place in order for gold to actually gain substantial value. And there's no way to put a time parameter on that.
All right. Well, I appreciate your thoughts. Very thorough discussion as always, Gary. And I appreciate you asking me a question. That was a fun exchange. We'll do more next time. Thank you so much for your time today, Gary. And thank you for watching Kitco News. I'm David Lin.
Thanks for having me. And we'll see you at the VRIC in Vancouver.
Oh, yeah, you're going again? Yeah, we'll see you again in January, of course. And for now, I guess follow Gary at where can we follow your work?
The Gold Forecast YouTube is now at the Gold Forecast, and Gary S. Wagner on Twitter.